Hello and welcome to Target Business English classes. My name is Jalil and I'll be a teacher today. Okay, so last class we were talking about the need to report the financial results of a company in English. So we started working on the necessary vocabulary to understand or produce such a report. So do you remember the name of that report? So we mentioned that there are three key sets of figures in the report. So that report we looked at was the profit and loss account. So also we have the balance sheet and the cash flow statement. So today we're going to be looking at the balance sheet, okay? And also the cash flow statement. So in part one we focus on the profit and loss account or the income statement as it is called in the United States. And today we are going to focus on the balance sheet. Now a balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholder funds, or as the Americans call it, equities. American English would be equities. In British English, shareholder funds. Okay. So this gives a photo of this information. It's a snapshot of that specific moment. Now these three balance sheet segments give investors an idea as to what company owns or owes. So if it is a profitable company or it's a company laid with debt, a liability. As well as the amount of invested money that shareholders have put into the company. So we can assess the balance sheet in a simple way. The balance sheet adheres to the following formula. Assets equals liabilities plus shareholders' funds or plus equities. So let's check the meanings of these terms in greater detail. Okay, so let's first look at assets. What is an asset? Well, an asset is an item or items of ownership that are convertible into cash. So you can think of your whole business. Maybe if you have trucks, if you have a logistics department, or if you have any invested money, invested capital, money can be capital, that would be seen as cash. Okay, that's an asset. So total resources of a business as cash notes and accounts receivable, securities, inventories, goodwill, fixtures, machinery, or real estate are seen as assets. Well, assets include many things. So current assets could be things which you currently own and have ownership of. Cash in the bank is a current asset too. Cash in the bank is what's in the bank. Securities, an important one. These are investments in other companies. So the company, sometimes, or personal people in the company, the board of directors, have investments in different companies. Remember Warren Buffett, okay? Securities. Stocks of raw materials, unfinished goods, and finished goods that are going to be sold. These would be capital, okay? These things are seen as an asset because they have a price, they have a value, okay? And also another asset, debtors. Debtors are people who owe money to the company. So these are seen as an asset because you can use these people to give you money when you need it. Well, that's what we hope. Okay. Also, we have fixed or tangible assets. Now, tangible assets are equipment, machinery, buildings, and land. These are the easiest forms of getting a profit, okay? Or making money, or getting cash quickly. These are very liquid products, okay? They are physical goods. And then we have intangible assets. Now, if you really need to understand this, you have many types of intangible assets, okay? You have an example which is goodwill. Goodwill is actually the value of the company and the value the company thinks it has. So think about Coca-Cola, think about Starbucks. These companies have a brand value, and this value sometimes is so expensive because the name has such a strong opinion in public sectors, in public opinion, in public life. And these are intangible assets. Facebook, perfect example. So first we looked at assets. Now we need to counterbalance the assets with liabilities. Liabilities are problems. They are things that can cause issues to any company. Now a liability is a company's legal debt or obligation that arises during the course of business operations. Okay? These are things the company needs to keep in check, or they could cause problems such as bankruptcy. Liabilities normally are settled over time through the transfer of economic benefits, including money, goods, or services. So when you have a liability, you have a debt, and you need to owe something to somebody else. So current liabilities can be analyzed as debts that have to be paid within a year. So an example can be creditors. We looked at debtors. Debtors are the people who pay you. They are the people who owe you. But when you are the debtor, you are a creditor. You owe money to people who you do business with, such as suppliers, such as other companies which you need to do business with. Overdrafts. Now, this happens when companies have a big bank account. Now, everybody has an overdraft. If you go to your bank, you put your card in, and you don't have any money in your account, you get an overdraft limit. That's a limit of money that your account has. Now, companies are the same as people. So when a company spends more money than it has, it uses its overdraft, and every overdraft has an interest payable, okay? Interest payments are also something that companies need to see, and they change over time unless they are fixed interest rate, and they have to be paid in the short term. So when you take out a loan or any type of physical borrowing that you do, you normally have interest if you use the official traditional methods. Okay? And the obvious liability that companies need to always pay, taxes. Taxes are very important to keep in check. Long-term liabilities are a little different than regular liabilities. They are debts that have to be paid further into the future. So, a long-term bank loan, we can look at as a long-term liability. You can renegotiate with your bank, and if you're a profitable company, a company that guarantees it's going to pay, you can maintain these loans further in the future. Another more important one would be mortgages. Now, mortgages are used for undertakings. Undertakings, houses, factories, physical buildings. We use a mortgage. We have to give capital, and we have to assure the bank that we guarantee to pay back what we owe. And this would be a long-term liability. So, shareholders' funds or equities are very important too. So, shareholder equity can be defined as a firm's total assets excluding its total liabilities. So we minus its total liabilities, okay? Total assets minus total liabilities. So in theory, this is what would be left for shareholders. If the business stopped operating, it paid all its debts and obtained everything that was owed to it and sold all its building and equipment, all that money would be owed to the shareholders. That would be what the company is worth, the physical value of the company. So shareholders' funds are shown as in a company's accounts, which include share capital, which the shareholders themselves have invested, profits that have not been paid out in dividends to shareholders over the years. Also, this could be retained earnings, which the company plans to reinvest in the company. So that's all for today. I hope it clears up everything. Next class we will focus on the cash flow statement, so please don't miss out. Thank you for watching our class, and we are looking forward to seeing you again. Thank you so much. Bye.